In this market update, I am going to be talking about where Thor stands today with the current market and what our indicators are saying. Hi, Jim Gore from THOR Wealth Management. Today I thought I'd give you an update on what our indicators are and how we are allocating money here at THOR Wealth Management. First and foremost, in order to be a successful investor over the long run, you need to have a disciplined approach. And we have a very disciplined approach here at THOR for managing money. Anyone can get an investment right and look like a hero, but that's like a blind squirrel finding a nut. They can find it once in a while, but it's not a plan for long-term performance. And that's what we want, is long-term good risk-adjusted performance here at THOR for our clients. The first thing that we look at is if the market is expensive. And what we're using is our THORdex, is our proprietary index that we use here to tell us if the stock market is expensive or not. And right now it's over 66. What does that mean for us? Well, if you look at the highlighted section, this is when the THORdex is between 61 and 80. Over the next 10 years, what can you expect in performance on the equity market? So it's saying here it's about 5.5% that you can expect for a 10-year annualized rate of return. Well, you can get more than that in bonds right now over the stock market. So you sit there and say, is it worth it? Well, a lot of people say, and you hear this, hey, always invest in stocks. Over the long run, you're going to get 10 to 11%. Yes, that's true. But it's important when you're buying into it. And the market at this time, with the market being expensive, this is not a time to put a lot of money work over the next 10 years because the returns are just not there. The best return over 10-year time for you could see is 10%. The worst is 0.42%. So what we're saying here is that the risk is elevated in the equity market. So we are underweight in U.S. equities. The next thing that we look at is on the fixed income side. And there's a number of indicators that we look at, but these are two most important ones: duration and credit. Duration is, do I buy a 2-year treasury or do I buy a 10 or 20-year treasury? How far out do I buy those securities? Next is credit. Credit, do I buy a treasury that doesn't have any credit risk, even with the government shutdown? Or do I buy a high yield junk bond that the company might go bankrupt and I might lose some principal value in our bonds? Right now, the credit side is a -1. So the duration, as you can see right here, there's very low risk in buying longer duration bonds at this juncture because rates have gone up and you are getting paid to take those longer term bonds. You're actually locking in some good long-term rates at this point. And in our models, we are at full weighting or above weighting in our fixed income side. And actually we're adding fixed income to our 100% equity model because we are getting paid to do so. And so therefore we are. So this is a time on to look at bonds as something that is more attractive. One thing I would tell you to be careful about, and this is especially on the credit side, is private credit. In the last 9 months, at least twice a week, we get a firm wants to come in and visit us and they're selling private equity. Hey, these are safe investments. You're lending money to these private firms that are, they're floating rate, so they're paying 7% above SOFR. Right? That was great when interest rates were 0, but now at 5-6%, you're paying 12% on these bonds, or that these companies are going to have to do it. And they're selling it as a safe investment because, hey, it has no volatility. It has no volatility because it has no pricing in it. So they price it at par because it's not publicly traded. The big risk here is these companies, just think about it, they pay 5% in interest, now they're paying 12% in interest. That's going to hurt your bottom line if you're borrowing $100 million. That's $7 million more in interest payments you have to make. And this is an area that we've seen hyped up from salespeople, just like we did in 2009 when you had to own the bricks. We'd have managers come in selling us emerging markets and international. And I'd ask them, okay, what are you seeing from other advisors? And they're telling us anywhere from, they had their money 30 to 50% in international emerging markets. And I look at them and say, if the money's there, how am I going to, who's going to buy it from me? And you got to worry about that with private credit. Back in 2009, we had the lowest international exposure we ever had. It was roughly about 4% in our 100% equity portfolios and nothing in emerging markets. Today, we like those spaces, and let's talk about what areas that we like. And this is alternatives. These are things that are not correlated to the stock market. We still like them. They've come down from where they have been a year ago because bonds have become more attractive. So alternatives are still attractive, but not as attractive as they once were. U.S. large companies, whether they're value or growth, are still not attractive at this point. Neutral is small company. They probably would be more positive at this juncture. But we see as the market drops, like we saw in the third quarter, as the market was down roughly 4%, microcaps were down 7.5%. As the market comes down, small companies tend to do worse, and that's because there's less liquidity in that space. But as the THORdex comes down, that is one area we're looking to add in our client's portfolio. Area that we like is on the equity side is still emerging markets, international, especially emerging markets, and emerging markets small company, not the emerging markets that owns the Chinese banks and Tencent and Alibaba that are basically run by the country. We want the smaller companies out there that are selling for a much cheaper price and offer us opportunity for growth. And MLPs, they're still attractive. These are pipelines, and they were the star performers in the third quarter, being up 9% as oil prices went up. And we still like those, not as much as we did, but they still are a positive, and we want to own them in our portfolio. The one area that we don't like is BDCs. These are publicly traded business development corporations set up in the 80s to lend money to mid-sized businesses. Same reason we don't like the private credit. We don't like the BDCs. We've been in and out of them 3 times in the last 6 years. They become more attractive. We have a credit event. That is certainly something that we would look at. Hope everyone has a great couple of weeks. If you have any questions about what we're doing or needing to have an investment advisor help you with your portfolio, please give us a call or reach out to us at THORwealthmanagement.com. Take care and look forward to talking to you in a couple weeks.